first thing I'd like to do is to introduce our first speaker. Guy Keller is Portfolio Manager with Tribeca, and Guy heads up the Nuclear Energy Opportunities Fund, which provides commodity analysis, and he also provides commodity analysis for the Tribeca Group. He comes with insights from the Macquarie Bank's mighty commodity trading desk, of which I've seen upfront myself. And with that terrific background, he's well placed to speak about commodities, but also very much about the opportunities in uranium and the nuclear fuel cycle. I'd like to, could you please join me in welcoming Guy? Thank you.
Only 20 minutes. I just want to start to say that I may own shares in some or more of the companies that will be presenting this afternoon, and I won't be giving any stock tips on individual companies, but we will talk more broadly about the sector. Tribeca Investment Partners, we're a boutique fund manager based here in Sydney with offices in Brisbane, Melbourne and Singapore. I work for the Global Natural Resources business. As part of that, we spun out our Nuclear Energy Opportunities Fund. Like our Global Natural Resources business, we're actively managed high conviction. We get into the weeds of the sectors and find stocks to fit the thesis. One of the big things that we have focused on Global Natural Resources in more broadly over the last few years is decarbonisation. Obviously, there's been a big push globally from both governments and activists. And the dual themes of decarbonisation, electrification, come down to that core theme. You can't achieve either without commodities. And from that, we build our broader thesis as to what the world looks like, how the old world can continue to operate with the new demands from this. We then, from a holistic view, form a batting order, and as you can see there, it should be no surprise that most of the metals and minerals in the bullish corner are all going to be doing with old world applications, as well as the drive towards decarbonisation and electrification. That's how we got interested in uranium. To be perfectly frank, 6 years ago when we started looking at it, I'd modelled just about every other metal, and uranium was the one that I was trying to avoid because it had had such a bad sort of run for a few years, and it flagged the most interesting from fundamentals from anything. This is a great slide. It is 2019 WNA, but 2021 is in fact more compelling. And I love this slide. And the reason I love this slide is because of all the coloured bars with prospective, planned, under development, restarts, where anybody that's spent any time in the resources sector trying to pull out any commodity, whether it's scrape pumping or digging it from the face of the planet, knows that most of that doesn't happen. And so the WNA are assuming that all of this stuff has to come to market just to meet their lower scenario, which, by the way, is completely out of date now that we're seeing governments pivot towards energy security. So that's something else we're going to touch on here that has tightened this thesis even more. Obviously, we've seen probably the biggest energy crisis the world has experienced, if not bigger than the 1970s, because it's affected the movement of hydrocarbons being crude oil, natural gas and thermal coal. That has forced a rethink about energy security where often the source of those hydrocarbons are not the consuming end market. That's caused a big change in our demand because all of the nuclear have, so we had, and the WNA and a lot of consensus modelling has had demand petering off because mature fleets are retiring, coming to the end of their useful life, or the useful life that was at least designated when they were built, which is around 40 years. All of these countries are looking to restart, to rebuild, to extend. And that's a source of demand that's being forced upon these utilities by government decisions, not commercial decisions. So, you've got a fuel buyer who's sat there modelling their demand out through 2030 because it is long lead. It takes 2 years from mine mouth to reactor core to get that uranium into a usable format, and with the more current geopolitical problems with Russia on some of that fuel cycle, it's going to be even longer. So these utilities are not thinking, they're not a coal-fired reactor thinking, when's my next truck of coal turning up so I can shovel it in? They're thinking, what do I need to do today to look forward because I don't want to run out of fuel? They've now had all these decisions reversed and forced upon them, which has required them to then have to try to find the fuel. Oops-a-daisy, one too many. And this is where we come into geopolitical risk. Whilst Kazakhstan is doing its best to remain somewhat neutral with respect to the conflict between Russia and the Ukraine, they are 41% of uranium supply in the world. Everyone talks about Russia and says they don't actually supply that much uranium, but they do supply a lot of the conversion and enrichment. That are the steps that the uranium, the yellow cake, needs to go through on its way to fuel fabrication and fabricated fuel rods to then be put into the reactors. And many of these, whilst we haven't seen any sanctions yet, a lot of countries are talking about that, and I think their utilities are telling them, please don't, because we haven't managed to secure that conversion enrichment supply yet. There's a lot of utilities, especially in the United States and Europe, who are starting to self-sanction. We have to honour our current contract, so we don't have any choice, but we're going to try to find other sources of that conversion enrichment for future contracting. And of course, those that with any capacity to increase that are turning around saying, well, give us this certainty via contracts, and then we'll turn on. We're not just going to turn on and spend the money for the sake of it. So we're seeing that coming through in these nuclear fuel cycle prices. We'll touch on the spot price in a second. But to me, this is a real activity in the market. Speculators such as myself, such as anybody else that's able to access sort of physical commodities and pricing, I can't get into the conversion and enrichment markets. It is user to user, with one or two traders thrown in, or government agencies. So when you see these prices appreciating through the fuel cycle, and you look at the spot uranium price and say, yeah, it's sitting at $50, I'm telling you, there's plenty going on. We have seen, the reality is this is a grown-up thesis, and it's the market capitalisation of the listed uranium exposure can fit inside that of Fortescue. So it supplies 10% of the world's electricity, and you can the investment case is very, very small. So it's a grown-up thesis, sort of being thrown around a bit of a schoolyard playground at the moment because it's not big enough to get that real money institutional investor in. It's certainly come a long way in the last couple of years, and I think it continues. But we have seen a correlation between things like Bitcoin and tech ETFs, especially in North America, and we track that via the ETF flows, where when they were losing money on the other two investments, looking at their uranium portfolio and saying, wow, that's held up, bang, I'll take some money out of that. And we're also seeing a big disconnect. We've seen the price of other hydrocarbons, this is Newcastle coal here, completely and absolutely take off to the upside, and uranium, whilst it has participated, still has not necessarily followed. So we think, the reality is, and we'll get into that in a second, it has to continue to go higher because it's not going to be a high enough price. The spot price, everyone's obviously heard about Sprott Physical Uranium Trust, and that's been a really good visible addition to the market. It's brought some transparency to a very, very misguided and misfiring of, you'll hear from Bram later on about the spot market. There's not very many players in it, they move it around as it suits. And they have soaked up some excess inventory, so they've been extraordinarily good at that. However, the flip side of that double-edged sword is now more people are looking at the spot price saying it's not working. But as I said, when we look at long-term prices, so you've got to think of uranium as iron ore 20 years ago or 15 years ago, when 1% of iron ore cargoes traded through the spot market, everything else was on a BHP contract reference price to a semi-annual annual price to Japan, plus or minus for grade impurities and location differences. That's the uranium market. Almost all of the real activity is a long-term contract between a producer and a utility. The spot market is a contract of last resort. In fact, if we were to update that bottom table now, I think the contracting volumes more recently based on Cameco's quarterly and what we've seen in the market it's coming up to £100 million. So it's showing that there is real activity happening again in the market. And let me tell you, people say £100 million has been contracted, surely that's it. No, still more to come. But a lot of the low-hanging fruit has been picked. There was been a lot of talk about small modular reactors, and people say to me, you've got government policy impacting demand in the short to medium term as for restarts and things. What happens if that changes, or what happens if that loses momentum? I only need visibility on that out to about 2030, and then these puppies start kicking in. And if you think back to, we talked on lithium, you touched lithium earlier, if you think back to battery electric vehicles 5 years ago, people trying to model lithium demand on the basis of this great unknown, which was what's the penetration of battery electric vehicles, what's the penetration of battery manufacturing capacity, and everybody got it wrong. Everybody was unders, and anybody that was overs on their lithium projections, or the other battery metals, at the time they thought they were crazy. These things are coming. There's no doubt about that. We've just had a week in Adelaide. We've had a number of conversations around small modular reactor technology. There is so much government money in the United States, in Canada, in France, in the UK, in China and in Russia invested in this. And it's not new technology. It is the modularisation and downsizing of existing technology. So there are some small modular reactors that are slightly different technologies that need to be passed muster for the Nuclear Regulatory Commission in the United States, for example. But NuScale, for example, the technology's approved. And it's coming down to building these in a factory, getting better at building these things. And we touch on decarbonisation. I mean, you can't have electrification of transport and say you're solving a decarbonisation equation if you're plugging it into a coal-fired power plant. You need to solve the decarbonisation of the electricity grid there as well. And if you can solve both the electricity and the transport issue, then that's a massive chunk of your decarbonisation equation there, which is why when we're having conversations about your battery and materials and what have you, you need to include conversations about uranium and nuclear in that as well, because again, plugging a Tesla into Queensland is not really giving you as great a benefit. Just conscious of time, so we can have some questions. The nuclear fleets are already avoiding carbon emissions, and that's been certainly a driving force in the US. I mean, they're 20% of the world's electricity. There's some statistics there in China as to what they're avoiding, and China is obviously a big growth engine. There's a lot of reactors currently being built, and that will continue on a year-on-year basis. And the mining footprint, when you look at the energy density of uranium per gram of material versus the tons of material you might need from coal, as well as a mining footprint. And we were out at site here last week. In situ recovery is more than half of the world's uranium, and it's an extraordinarily small environmental footprint compared to stripping the face off the planet. And I guess this is just a bit of a touch here on the energy density. Everyone talks about like for like. A gigawatt of nuclear is the same as a gigawatt of solar. It's not. Because solar doesn't work all the time. The sun does go down, the wind does stop blowing. You need more capacity installed, which is more commodities. And we could talk about that till the cows come home. Plus, there's lots of other things. We've got Elon in here, because crypto mining, data centres, things like that, there's pressure for them to be greener. In Susquehanna in the US, there's a data centre and crypto mining going next door to the nuclear power plant there, using green electricity that has to scale back when the wind shines and the sun blows. You know what I'm saying? You've got some really big people starting to drive this. Bill Gates, I mean, he's obviously got a financial incentive because he's invested in TerraPower, which is a small modular reactor technology, but he's getting very vocal about it. And more recently, you've seen Brookfield Renewable Energy Partners. I mean, there was a lot of talk about what this means for Cameco. So they both have taken out Westinghouse Electric, which Brookfield Headco acquired out of administration. Everybody wanted to focus on Cameco, and I said, hang on a second, this is Brookfield Renewable Partners, right? They are a green, renewable energy transition investor, 125 gigawatts of capacity and development online, who've just given a big fat green tick that nuclear fits their ESG and energy transition story. We're seeing the EU green taxonomy come through in Europe, but nothing's come of that yet. We've seen the UK make it easier for green bonds for their pension funds for their Sizewell C. But this is actual dollars being spent by an energy transition and renewable investor. And in fact, I had a meeting in South Australia where there was a super fund down there who didn't want to know whether he could invest in my fund, but wanted to know what all this fuss about ESG and Brookfield, and should he be getting skilled up on the fact. And I said, absolutely, you should. I'm more than happy to spend an hour of my time to help you along that. So that's been a massive game changer for me, and I think you'll see more ESG and more transition funds looking to work out how they can get involved in the sector. Very quickly, our portfolio. I'm trying to do 15 minutes here. I've got 10 seconds left. There is, that's sort of how we look at things. We break things down by exposure tags, so that, there's not that many, here we go, that's done. Not many companies in the sector at the moment. In the last cycle there was 500, I think at the moment there's about 40 or 50. And so, as I said, I don't really like talking too much about individual stock holdings, so we break it down a little bit to give our investors an idea of where we're focused. At the moment, there's a huge amount going on the Explorer end of town, and you've got a good lineup of speakers coming. There's a lot of projects shaking out from last cycle, and so there's some great opportunities there. And this is just a little comparison of our strategies. So, there's been some pretty lumpy performance. We've managed to outperform the most of the sector ETFs because, they rebalance every 6 months. We're in the weeds. We're moving actively and proactively throughout, and then most of the time, apart from recently with Cameco having a reasonably good performance, we're outperforming some of the larger things as well. So more to come. I think it's certainly the beginning. We've seen, as I said, from that performance, some sort of a turning around saying that's it, well done, congratulations. I don't think that. I think we're actually at the beginning of a multi-decade acceptance of nuclear power, where the technology in this case is not a disruptor. It actually contributes to the story as small modular reactors become much more palatable for the world. So that's all I've got to talk about. If there is some questions, I'm more than happy to take them.
No, I might start. So,
sure.
PAC, so appreciate your participation. So just curious, probably an easy question, but obviously, incentive pricing for new projects is arguably significantly higher than where spot is today. But when are we going to see that sort of start to, rubber meet the road, if you like, with regards to demand profile and pricing required to finance projects?
Yeah, I mean, it's certainly. A few years ago, because I was trying to find an ESG slide that I put up just to prove I was right, but couldn't get it in time. But I'll find that eventually. 4 years ago, there was a consensus that an incentive price to bring projects to market was $40, and that's now moved to $60. And I'm saying at $60, it's not a high enough price. You've seen mining cost inflation across everything in every part of the world, I think some of that it could move through with supply chain and what have you, but a lot of it's here to stay. Unfortunately, when you look at the long-term price that the two price consultants put up, they're looking at a long-term contract that's been agreed already. They're not sitting there saying, as an equity analyst should do, my 5-year price forecast is X. They're saying that's what's done. So $52 is a price that's traded. And then the analyst community is sitting there saying, well, that must be the long-term price, so I'll plug that in, or maybe I'll get it to $60. I'm saying rubbish, because these guys are just paid to report what's happened, not what they think is going to happen. And if you look at any of your projects in the stable that you cover and turn around and tell me they're economical at $60 or $52, I'm saying forget about it. I mean, you've got brownfields restart projects signing floors there or thereabouts with a 5 on it. You've got Cameco doing the same thing, signing floors in their contracts around, with a 5 on it. But you can't tell me a greenfield project that's got a resource and a blown out capex, it's not none of their fault, but because of the market. You can't tell me that they can honestly, hand on heart, say they're economical here. So, I look at everything now and I say $75 is where I'm starting. And I don't care what others have got in their market, in their models, because I'm sitting there saying, if somebody approaches me and says, I'm going to go and raise some money or project finance into development and I'm going to sign with a 5 on it, I'm saying forget about it, not interested. And so, you know, we saw that last cycle as well, because it is one of those industries where those price reporters do dominate, whereas other industries, you know, analysts have been forced to make a forward curve either based on a futures curve and add some, or whereas here they tend to rely on that a little bit more. So it's going to be interesting, and you will continue to find consensus forecast price lagging to catch up to the price moves.
Great presentation, thank you. Black swan events that might affect the industry, specifically Zaporizhia in Ukraine.
Yeah.
Could you give us a comment on that?
Yeah, I mean, that's always a risk. The reports of conflict in that region so far have been, you know, around small arms fire. To properly take one of these things out requires a targeted bunker buster, which means it is a deliberate political and strategy, military strategy to do that. And my argument on if and when that happens is, somebody asked me, how do I hedge for that? And I said, well, how do you hedge the rest of your investment thesis? Because that is an escalation to World War III and potential global nuclear conflict. You know, so that is certainly a black swan, but you know, people around those reactors in the context they're in is not a risk to those reactors. There's so much concrete and cement and what have you and redundancies built into these things. But yeah, I mean, it's a sentiment, sure. You get a headline of there's small arms fire or there's troop movements around the reactor, and the sentiment causes these things to roll off. But as I said, you know, I sort of sit there and say, well, to me that's a buying opportunity because it requires a proper military targeted strike to do so. You know, I get asked a lot whether other technologies are a disruptor, and my response to that, you know, the obvious question is that grid scale battery storage will catch up and solve that issue of the intermittency of renewables. So we've still got to build the capacity to be able to charge them, and I don't see any money on a large scale being invested in that technology. I mean, you've got the UK government throwing £450 million at Rolls-Royce for small modular reactors. You've got the Department of Energy, Department of Defence in the US throwing hundreds of millions of dollars. You've got Canadian government, all that small modular reactor technology. I don't see them throwing similar amounts at grid-scale battery technology. So, you know, I say, yes, that may catch up in some way, shape or form. If it's vanadium redox batteries, great, because vanadium is a byproduct of uranium mines in many cases, so winning. But yeah, I don't see that, because I don't see that the urgency to push that. There seems to be a suggestion that it'll catch up. And then, as I said before, I mean, small modular reactors is a technology advancement for the thesis, because it still requires uranium, and yes, it requires less, and they're building these things to refuel less often, which makes them inherently safer, but they're going to be building a lot more of them. You know, so you'll get that scale as that rolls out.
Terrific. Thank you very much.
Excellent. Thank you for having me. Cheers.